Welcome to the Finance Podcast. The topic of this episode, Democratisation of Alternative Investments, with the speakers Marcus Benzler, Thomas Davies, Nalaka da Silva and Premal Vodgoma, moderated by Christian Trixel.
I think we can start. Ready, panelists? Good, very good. Audience ready? I think democratization in alternative investments seems to be a good topic. So many thanks for joining us today to our panel. Many thanks for the highly decorated panel as well. I will give you then a bit time to introduce you. We have Marcus Benzler. He's head of multi-manager private equity at UBS Asset Management. We have Thomas Davies, CEO of Forge Europe. We have Nalaka da Silva, head private market solutions at Aberdeen. And last but not least, we have Premal Vodgoma, head commercials at Gotchi, which is part of Euroclear. Right? Myself, I'm Christian Trixel. I'm country manager of Amundi, Switzerland. In terms of conduit, I will give you the chance to briefly introduce you personally as well, give you a few words on the company and your mission. Then we will have a short slide introduction to set the context in terms of alternatives today, and then we will dive into the Q&A. To keep it as interactive as possible, please ask questions. Finally, we are here for you, to serve you, to match your expectations, so when you leave, you hopefully have all the answers to your question you might have in this context. Okay? So with this, I would like to hand over to you, Marcus.
Thanks. So my name is Marcus Benzler. I'm almost 20 years with UBS. UBS obviously being a large shop, I'm part of asset management, so we take care of institutional clients, so pension funds, insurance companies, sovereign wealth funds, some large family offices. I'm there part of what we call multi-manager platform. We manage about $45 billion in private equity, private infrastructure, private real estate, private debt. We have basically 20-person investment team just for private equity. The entire platform has roughly 120 people. And then on the democratization side, we have one of our products really geared towards that market, which is called Evergreen Secondary Fund, and that's focused on secondaries, and investors can come in on a monthly basis, can exit on a quarterly basis, redeem, and basically that's with a minimum entry size of 50,000 euros, dollars, Swiss francs. So we especially sell that through other wealth managers, distribution partners, as say one of our contributions to democratization.
My name is Thomas Davies. I'm the president of Forge Europe. I am a former lawyer, probably recovering lawyer, I think is probably a better term. I started my career at Freshfields in London and worked in Hong Kong and New York. I then leapt out of the corporate world and joined the startup world in 2012, where I joined Cedars, one of Europe's largest equity crowdfunding platforms. So democratization of investment is kind of in my DNA. And since then, I've been set up a couple of businesses myself, and then I've recently joined Forge Europe. Forge Europe is a marketplace for the buying and selling of private company shares. We are a US company. It's been going for about 14 years. We've transacted about 14 billion through the platform. And then Deutsche Börse in Germany invested into Forge with the view to bringing the offering into Europe. So I joined the company about a year ago. We've been sort of going through all the regulatory licenses, building out the team, and we're now live and open for business, started settling our first few trades. And we have a very strong technological platform to connect both Europe and our US parent company into a global interest book where we can match and settle trades across the Atlantic.
Thank you, Thomas.
Thanks. My name is Nalaka da Silva. I head up our private market solutions group at Aberdeen. Aberdeen is a large multidisciplinary asset manager. We run about 500 billion sterling of assets under management. About 80 billion is in private capital market, so that's private equity, infrastructure, real estate, private credit, private debt, natural resources. I'm responsible for the portfolio construction and implementation of introducing that risk premium to pension fund insurance clients and developing strategies that on a segregated account basis for large sort of family offices. When it comes to democratization, we've spent a long time looking at how we can deliver that risk premium, that private markets excess returns, into more mainstream portfolios. There's a big change in the UK and internationally from defined contribution to defined benefit to defined contribution. So those have typically not had exposure to private markets. And when we developed that, we built a strategy that allows retail customers essentially to get access into all of these asset classes that typically they didn't get access to. So we now have a program that's sold and distributed internationally that allows access into the best of venture capital, private equity, infrastructure in many forms, real estate, private credit, and we work with a range of platform providers around the world to try and democratize that and give people access that to much smaller ticket sizes. As sort of Marcus mentioned, they've reduced that entry point to 50,000. We're roughly at about $100,000 to get access into that program, but it's much much smaller than the 10 million that you would typically need to get into some of these private markets programs before. So that's us.
Thank you.
I'm Premal Vergama. I'm a commercial director at Goji. We are a private assets fintech that was acquired by Euroclear in December 22. Our technology digitizes and automates the entire life cycle of onboarding, subscribing and managing post-subscription activity within private market funds. Where we are today is we've fully integrated that into Euroclear's fund settle platform. So that means clients of fund settle can access all asset classes through one single platform, whether it's evergreen or committed capital vehicles. And so my role is to work with alternative asset managers, like the peers we have here today, to support.
Thank you very much. Very interesting also, and I think a very good constellation of our panel. Maybe can we have just the slide to set a bit of context? So you see, probably not from behind, but maybe you can see it anyway, But one thing which I think here is a message I want to share is that the total market of private market alternatives makes up 10% of the market, total market capitalization, so roughly 10 trillion. So in the meantime, it is a significant part we cannot wipe out to have a conversation about alternatives anymore with clients and also as provider. Then the second message, and if I may just give you a bit, the top spot here is showcasing here on the vertical axis the performance and the horizontal x-axis the risk and volatility. But when you look on the private equity, which makes, by the way, up 60% of the 10 trillion market in the meantime, you see a performance close to 14% with a relative low volatility. So when you go through and compare it with the US equity, which is a asset class in a traditional context, which is also delivering decent performance around 8 to 10%, but with higher volatility, you see immediately that alternatives and private markets offer in itself a very, very nice and appealing risk-return profile. Private infrastructure, roughly 12% in a 10-ish volatility range. Private US real estate, around 8%. Private credit as well. And you see here the traditional asset classes deliver also decent returns, of course, like emerging market equity, but with high volatility. So one message is it is an appealing asset class, which has an absolutely nice risk-return profile. The second is the size of the market in the meantime, which makes up 10% of the total market capitalization. We cannot discuss away. We need to have a conversation. And finally, why should alternatives not be made available to the public? And that's the subject we want to discuss today, democratization in alternatives and alternative investments. So with this, I would like to turn into the first question. I know you partially already elaborated on it, what democratization means from a provider view. I would like now to maybe extend it a bit and say, well, democratization is one bit, but where do you see the limits as well? If I may start with you, Markus.
Thanks. So democratization for me is smaller entry ticket sizes, we talked about it, but also making the whole investment process easier. You know, most of the private markets is cash flow based investing, so you hand out a commitment to an investment manager, and then this is called down over the subsequent years, be it 3, 5, whatever, 7 years. And that makes it for larger parts of the investor-willing investment base quite difficult, right? So for another part for me is democratization means you need the right fund structures, and you probably have to end up with open-ended funds which are fully paid in as opposed to these cash flow-based structures. So the limits, well, what we see already, I heard that Luxembourg is currently, for example, which is one of the main hubs for us where we structure our funds. So they already look into that, what can be regulated on the semi-liquid fund base, because they realize this is an emerging, booming part of the market, and they want to establish certain minimum standards. So all types of asset managers are consulted, they have their own views, and I would expect there's something to come out in the not too distant future. So that already tells you something. Well, there's a need to regulate certain things, and particularly for me, the key point is always only investors who understand the risk can invest in. And then understanding means, for example, on the private equity side, if you do a fund-of-fund investment or you invest in a broadly diversified secondary fund, you really have to work hard to lose money, right? So if you look in 20 years back, large databases of fund performances, you're in the bottom 1 to 3% to lose money. However, in another part of the private equity market, if you invest in like a single company, a venture investment, or even a venture capital fund, it's very likely, or certain chance higher than 10, 20, 30% to lose money, depending where you invest. So from especially that perspective, which I think mostly is quite well covered by the regulator, you need to put certain limits to the investors who can invest in.
Thank you very much.
I agree with all of that. I think what I'd add is two things. I think the first thing I'd say is one of the greatest examples of democratization of an investment, I think, is actually the public markets. You know, if you rewind back, that wasn't traditionally available to everyone. And you know, the reason why it's been so successful, I think, for me, is a combination of both transparency and information, as well as the appropriate regulatory structures around to protect all of the participants involved. And I think what it really comes down to me is making sure that there's a level playing field for everyone. So for me, democratization is around transparency and fairness in the market. In the world that we operate in the private company space, there is inherently a tension, I think, between what the companies themselves want and need and the reason why they remain private, and what the investors in those companies need when you try and democratize that with a flood of information about the company. I'll just add one stat, which I think is very interesting. Between 2000 and 2010, the median age of a IPO of the companies that IPO'd was around 7 years. Between 2010 and 2020, that had increased to nearly 13 years old. Now, there's huge reasons for that, but a lot of it is driven by a huge inflow of venture capital. There was no longer such a desperate need for these companies to go public in order to raise money. And there are huge advantages to the company in not having to disclose a lot of information and not having to be super transparent about what they're up to. And that tension is one that we wrestle with when trying to open up the market of investing into private company shares, providing the transparency that I mentioned with an asset class of companies who don't particularly want to share that information.
Thank you, Thomas. Maybe let's go to an add-on question. I mean, a lot of investors I'm talking to currently, they say, well, you know, the illiquid premium in itself is paying nicely, and we can actually afford to stay in the illiquid space. Do you think the democratization is really taking place? You see the flows coming through, and if, when, in what type of asset classes do you see that? Maybe Nataka, to you.
Yeah, we absolutely. I think it's been around in many markets for many years, where pension funds have taken allocations to private capital, venture capital. But when it comes to mainstream access, I think we're now seeing people prepared to take more risk on the basis that we've just discussed here, because the markets have been more volatile, and therefore they're looking for less volatile return streams and higher return for that excess return that comes from illiquid assets and complex assets being delivered to the market. I think the challenge will really be about how to kind of make that illiquidity premium last when there's a huge amount of capital inflow bidding prices on what I would describe as the core part of the market. So if you've got high quality businesses that are quite mature or with defined income streams, private credit is a good example of that, where spreads on private credit, so the amount that you generate above a public credit asset, we saw periods where those got really contracted because everyone was buying private credit. But the default risk hadn't changed, just the spreads, but you were still generating a premium. So I think the challenge for allocators into private capital is making sure that you're getting paid for the right risks and getting paid for the right risk premium, whether it be venture capital or private credit or private equity. You're always going to be able to generate a higher return from private markets because it's inherently more risky for a number of reasons. But that relative value between illiquidity premium and allocation, particularly if, let's call it, 30% of an allocation of everyone's savings and pension pot or defined contribution pot starts chasing high quality real estate or infrastructure assets or private credit assets, that's going to put pricing pressure down. And in the event of default or in the event of you're not going to be able to trade these assets out quickly. You're going to have to manage them. So that's I think, the sustainability of that illiquidity premium that needs to be understood.
Thank you. Primal, you see the similar trends on your platform? I mean, there are a lot of providers probably approaching you now in the meantime and say, well, we need to have type of shelf to use. And
yeah, I think one of the big differences or changes that we've seen in the market particularly is, and I think coming back to your earlier question, is what's democratization and what does that mean? I think product innovation is one thing. I think if you rewind 5-10 years, particularly in alternatives private markets, managers would fundraise from vintage to vintage. It wasn't distribution the same way we see in mutual funds. Whereas there is a convergence, I think, when it comes to the different types of products that have now led to broader distribution across platforms like ours. And from our perspective, we're agnostic to the ultimate structure. So whether it's an evergreen structure or a committed capital vehicle, we can support those that the clients want to invest into. But I think in terms of what we're seeing in the market, there is a strong push towards open-ended evergreen structures, where they're more suitable to a particular investor class that are new to these types of investments. They offer liquidity at different windows compared to closed-ended vehicles. And I think from an asset class perspective, typically private credit and private equity, but we are seeing a broader range of products coming to market.
Very interesting. Thanks. The offering and the shelf is one bit. Then I understood as well, information to end clients to be quasi-sophisticated enough. Is the regulation already there, or is the regulation observing this type of questions which might leading to quasi-bad surprises? Markus?
Yeah, as I said, I think obviously we are working already in a regulatory framework, right? So it means not every investor can invest in every type of fund. There's more regulated, there's less regulated fund managers, fund structures. So a good portion is already covered. However, obviously about the specifics of semi-liquid products, which is one of the key items besides tokenization and so on, which is driving forward the democratization, I would say they're learning themselves. And I mentioned this semi-liquid fund which we launched. When we started launching this one, there was basically globally half a dozen of products out there. Now we are talking about 40 to 50. And that's more private equity, sometimes mixtured something in, but that's basically last 4 years, right? So there you see that as basically the industry develops, also everybody understands, well, there are certain risks we have to understand, and then do we need to regulate or not? And as I mentioned, there is something going on, and I think at least in Luxembourg, but I think it's even on the European level, they want to set certain minimum standards for the semi-liquid funds, meaning what tools of liquidity can be provided in some very regulated format. You have to go to the regulator when you put in a lock to the redemptions, right? Usually most of these funds work with gates. And then in some less regulated formats, I think they want to leave it up to the fund managers, but in the more regulated formats, probably you will at one point have time to go to the regulator. And then they look at it and say, well, actually you can leave the fund open, you don't have to close it. So there are things, but I should say, there's a lot in place, but these specifics that are around the semi-liquid funds and also tokenization, I'm much less of an expert, actually no expert at all. I think they have to learn, everybody has to learn, and then there will be probably at one point in time some regulatory consequences.
Oh, that's interesting. If someone wants to add, please do so. But I think the access of alternatives is really moving fast forward. I mean, we have now platforms like Moonfair, iCapital, etc., which is offering private investors already direct access. So in this context, I mean, intermediation means via banks that or wealth managers in itself that you have a certain type of advice you can expect to get to a certain type of sophistication level. Are you worried?
One thing I'll add, just before I answer that, is a bit of an anecdote of my Seeders days when we first started. So for those of you who don't know, Seeders was pretty innovative in its time. We got authorized by the FCA in the UK in 2012. And it was the first platform that allowed a true retail investor to buy shares directly in a private company, and the company was allowed to solicit that via our platform. And it was a bit of a marketing gimmick, but the minimum investment on our platform was £10. It really was, the brand was, anyone can now participate in this, provided that they demonstrate that they understand the risks. And all credit to the FCA, we worked incredibly hard on working with them within the current guide of the regulations, but trying to adapt them to be able to allow these retail investors to demonstrate that they can actually understand the risk. And we spent a lot of time and a lot of work putting in the guardrails to ensure that protected them, but also opened up this asset class to what we called the mass affluent. So rather than the top 1% of wealth, it was open to the top 20%, the dentists, the mid-level marketing managers, people who had enough money to invest in this asset class but couldn't traditionally. You fast forward to today, and I can say this because I'm no longer a shareholder because the company exited, there wasn't actually a huge demand for that asset class. So we spent a lot of time, a lot of money, and the cost to serve these retail clients is very, very high. And there wasn't a huge demand. The retail, although we had this great ideology that they would be flocking to go and invest in the next Facebook, the reality was they didn't. And I think where regulation and what we were just talking about in terms of the structure of the products and the innovation around the structure becomes really, really important, because you can spend a lot of time trying to open up certain asset classes and certain structures to those asset classes and work very, very hard to try and get the regulation to catch up with that. And fundamentally, the customer doesn't even want that. And personally, I think also we need to not bucket retail into one great big bucket. Retail is made up of people who shouldn't be touching this at all the way through to people who should be self-directing and picking exactly what they want to invest in, and a whole grey area in between. And different structures will service those differently, and the regulation needs to account for that, in my opinion.
Interesting. So we were talking about innovation and probably more about regulation, whether regulation can capture this innovation speed. What type of product innovation do you see, Nataka, coming up?
Look, I think there's going to be we talked about liquidity. I think liquidity is a key issue, particularly for retail investors or anyone that can't afford to hold on to an asset for 10 years or 20 years, because the domain for private capital was insurance companies, pension funds, people that had a long duration of capital, or if you were a high net worth that was looking at legacy, you could hold your assets for indefinitely. So when we start reducing the time frame for these, liquidity management is really important. And we see that in the real estate sector, where the real estate sector was daily dealt in the UK, which is bonkers in my mind. It's, how could you sell a building in T+2? You can't. But the marketplace kind of got used to the fact that it was traded enough that you could create so I think the next step was, how do you make these assets fungible? How do you make the assets held in a structure which doesn't allow the asset to be traded, but a secondary market to be created where there creates depth in that market, so you can still get exposure, but you can still exit an asset, and whether it's sort of a different form of securitization or different forms of platforms that allow for matching, or we move into the future of blockchain and tokenization, which allow fractional interest. And I think that will be the biggest piece of innovation that will unlock it. But ultimately, going back to the disclosure points, private markets generate risk premium because they are private. No one's going to say, look, what we're really building is the next biotech company with this IP, and it's available to you, on a quarterly earnings cycle. So you have to trust that the value creation is going to be private. You have to trust in management and the ability for management to execute that plan, and for you to hold that asset in a regulated vehicle. But understanding your liquidity requirements, the disclosure requirements, and the value creation of the underlying asset will be how we end up having to mismatch that. And that's where we need the platforms to be able to be an information dissemination mechanism for that information to allow a well-informed investor to be able to choose assets, and a less informed investor to say, do you know what, I can't understand the risk around that. So those two things, I think, are really important.
Can I just add one thing?
Sure. Can I just ask one thing? Surely not. But then in effect, you would say that democratization is somehow paradox, right?
Yeah.
It is. Yeah.
I think it's because people have to... an anecdote around it is term deposits and long-term savings, right? So we earn a premium for investing for a long period of time if we buy a term deposit that matures in 5 years' time or 10 years' time. And people are happy to hold that for that period of time to earn that excess return. The bizarre thing is that people think about private capital assets, private equity, and they want it in a quarterly dealing or a monthly dealing format. But it takes 7 years to generate the value. So by illiquidity, you generate the premium, but by providing liquidity, you erode it. So that's the paradox in this. And I don't think you're going to solve that overnight by saying property is a daily dealing fund or private equity is a daily dealing fund. What you have to be able to make sure is the governance around these assets, that value creation is happening, and that's valued appropriately, and the market can trade it, and understand the tradable value of that so you can hold these assets. And we've tried it in different forms. In investment trusts in the UK have held illiquid assets, open-ended funds have. But in order to genuinely democratize it, I think there has to be trust in all of those layers together. Can you access these assets appropriately? Can you implement them through your fund structure or regulated in a way? Do you believe the valuation of these assets? Do you believe that you can trust management on the valuation? And that stack is going to take some time to really develop. But when it does, and people, I think nowadays I feel private capital markets are sort of not in the alternatives basket. It's probably closer to mainstream, because you've got digital assets and crypto assets at one end of the spectrum, and I've got schools, hospitals, private companies in the middle, and then you've got public companies. So it's actually not that much of a stretch when you think about the risks involved with those assets.
Thank you. You wanted to add something?
Yeah, I was just going to add, a word of caution is that I think that sometimes people think that the only solution that's needed to be created to create liquidity is a structure, so tokenization or some sort of form of it. And I think that's a dangerous road, because actually it sometimes works, and REITs and things like that have proven where you've got a very illiquid asset can provide liquidity at the top level. But ultimately, I run a platform where we are, facilitating the trading of private company shares. We've brought a lot of efficiency, a lot of scale, a lot of liquidity into that market. That asset class, though, will never, ever be a highly liquid asset class, and we're okay with that. And there are many reasons for that, not to do with the structure. And often it's to do with, again, information and lack of transparency and lack of any fundamental movement of pricing flags, which would result in the need for high liquidity. So I think tokenization is a bit of a bugbear for me, because people think that that's needed, and suddenly there'll be a liquid market. And I
I'll
don't
come
think
to
that's right.
tokenization in a second. You, Markus?
Yeah, then let's keep it for the next one because it was about tokenization and democratization. Then
Okay.
I keep it for the.
Because
don't want to destroy your
from what
flow.
I understood, somehow talking about product innovation or innovation, it seems to me that almost the private market asset classes sounds like there will not be probably a lot of innovation which we can expect, but we can expect innovation in terms of shelters to make it accessible. So LTIF, RIFs and LQIFs in Switzerland, but also tokenization apparently, right?
But let me, maybe one thought I had, which I think fits in here better, is even on the private market side, at least we saw a lot of developments the last couple of years, right? If you see infrastructure is now a standalone asset class. It wasn't the case 15 years ago. So we split out the infrastructure team out of the private equity team. Then just looking on the secondary side, you have now something called GP-led. So fund managers basically concerting a transaction as opposed to in the past was something we called LP-led, so we bought fund stakes from other investors who wanted to sell it. Now there's an entirely different part of the market, which is half of the secondary market. And then another one, also again on the secondary side, now most people do not talk about secondaries in general, but secondaries for private equity, for infrastructure, for real estate, and have dedicated products for that. So the market is further professionalizing and maturing, and I quite frankly, also the growth curve will flatten, but I think there's still enough innovation also on the product side, not also only on the structuring side.
Okay, very interesting. Fermo, how do you handle that?
Yeah, I think coming back to the earlier point that it's not one homogenous set of investors, ultimately, when they're looking to access private markets, and there's not one silver bullet that means an asset manager can suddenly set up a particular fund structure and then go to access retail investors. So I think there will be, as Marcus was saying, innovation within private markets across different structures, different asset classes, different ways in which ultimately new investors can get access to the market. And so from our perspective, when we speak to asset managers, ultimately, they want to be able to achieve scale. And being able to leverage platforms to streamline efficiency of investor access is a way that they can scale. I think the D2C point is interesting. Whether managers want to go direct to the end retail investor, that's another level of risk that potentially they don't want to do. From our experience, there's kind of the risk of managing that retail investor as opposed to the intermediary. But then alongside that, there's can you manage operationally to support onboarding potentially hundreds or thousands of individual investors, which in our experience, no one really wants to do on the private market side. So how can we think about aggregating orders? How can we look at streamlining that process? And that's where we can support, allowing managers to get real scale across kind of individual investors through intermediaries.
Very interesting. Before I open the floor to questions, to you maybe one bit which might be interesting as well is cryptocurrencies. I see a lot of cryptocurrency providers here. Interestingly, there were some guys getting vocal over weekend. I don't know whether you have seen it in the press as well, that our Swiss National Bank should invest in cryptocurrencies as well. So it will be an interesting debate. So maybe the other private equity guys should run around as well and ask them to invest in private equity, and then we have then the democracy somewhere else with our national bank. But factually, one thing which I think is interesting, cryptocurrencies itself, also after this short, not decent too long ago blow-ups we had, is it an alternative investment which you think we should also address as part of alternative conversation? I don't know, Markus, your consideration, you have a lot of wealth around the world you need to serve.
As I see it from private equity investor perspective and our funds, we do quite a bit also in venture and growth capital. There was quite a bit of crypto activity. Mostly it's around, however, this picks and shuffles theme. So you build the platform, the programming language, and because everybody believes that at least there's some value, but most see it around the tokenization. About cryptocurrency, I think it's one application, the first killer application which we've seen in there, and for me it's an asset class, but I would say you need to be a very understandable, skilled investor to maneuver your way around. So I wouldn't touch it, because for me, like private equity, private markets in general, it's a skill-based asset class. If I don't understand, I don't invest. But for me, it apparently proved as an asset class. And I would have expected a regulator to come in much earlier than they did, because it felt like in some parts of the market like a bonanza, and we all knew that there's some exuberance. So I know from a lot of colleagues that they would have expected a move much earlier than actually happened. But for me, it's an alternative asset class, and it's apparently there to stay.
Something to consider. Should we open to the audience? Questions, please. Yeah, try it.
Nalaka da Silva, you mentioned the role of trust to the management. That reminds me that with respect to actively managed funds, you also have a kind of trust problem, because you don't really know if they really do actively manage a fund. So would you say that there is also a similar risk of activity washing in private equity or private market retail products, or is it completely different?
I think there are some similarities, and the reason that the public markets create such a high degree of disclosure requirement is to try and provide that information for people to make informed decisions. Now, if you can't get a P&L, a balance sheet from a private company because it doesn't want to disclose that because it's the IP of that business and they don't want to disclose that, it's difficult for the broad audience to be able to say, I can trust that. So you have to look at track record, you have to look at, have those, if they don't provide disclosures, can I understand whether that management team is going to deliver the assets? And I think the difficulty when it comes to democratization is that you need to have a high threshold of information. And to make it comfortable for everyone to invest and understand an asset, and I think the more understandable assets are cash flow driven assets, so a real estate asset or an infrastructure asset where I've got a contract to a government and the government pays me inflation-linked cash flows. So I think infrastructure will be one of the more accessible or democratized assets first, because you can understand them. As you move, let's call it, through the complexity end of the spectrum, so a private credit manager, it's still credit, but you're lending to a complex business. When I say credit, it's not a senior loan where it's collateralized against a single asset. It's got a range of options. It's got different interest payments. It's got different collateral packages that go around. So the complexity then becomes a bit more confusing for people who aren't close to that marketplace, and you need expertise to be able to pick those stocks or pick those underlying assets. And then you get to venture capital, which is even more complex in nature. So somebody has a good idea in a PowerPoint presentation, and someone tells you it's worth $1 billion. And so that spectrum, I think, needs to be addressed from an educational standpoint. So when people, because the risk premium is real, you can see venture capital, and over the last 2 decades, the cost of capital in venture capital has decreased dramatically. If you want to start a £1 billion business, it doesn't take that long, and you don't need that much capital to do that. But if you want to get in at the ground floor, you can't do that through the public markets. You can't go and buy Amazon on day one or Microsoft on day one, when perhaps 30 years ago you could have, with Apple, Amazon, and some of the big stocks that we see today. If you want to get into the companies that IPO 13 years later, you need to get that through the private markets. But you have to trust that the people that are picking venture capital companies, which fail fairly regularly, are going to do a good job. So that trust needs to come from some kind of disclosure or track record disclosure. So when you're balancing your portfolio, and we talked about all the innovation happening at the asset level, GP structuring, secondaries, all of that. When I build portfolios, I don't really think about the wrapper. I think about the exposure. What am I actually buying here? And is that cash flow going to turn up on time? So if I expect a cash flow from a sale of a venture capital business in 5 years' time, what's going to drive that? Is it, you watch the company grow, the earnings grow, the market cycle, and you say, whether that valuation is going to go from 100 to $1 billion, over that time frame. And you have to provide a lot of resource into that. And I think until the marketplace starts directing that disclosure from a regulatory standpoint for people to start elevating that, I think you're going to end up in the same situation that Thomas described. You build a product, but the market goes, ooh, it's not quite enough for us to be comfortable with it. And I think as it becomes more mainstream in, let's call it, savings products, so defined contribution, where defined benefit pension funds used to just take the risk on for the members, but in defined contribution, you do that yourself, and it's your own personal savings pool. Those are the biggest pools of capital that are going to grow over the next 20 years. And they're going to demand greater disclosure. So the asset people are going to have to change their way of thinking, not just going to the 5 top pension funds around the world and raising $1 billion each time. So that trust, I think, comes from disclosure and track record being displayed.
Thank you, Natalka. Any other questions?
How is your confidence that these evergreen products would work regarding liquidity? Do we have some examples that it can work even in more dire markets?
I start. So yes, there's in fact quite a bit of a history of semi-liquid products. We ourselves have a company that we launched, which is now listed on the Bern Stock Exchange, but it's listed now after GFC decided, well, we need a more regulated format also in Switzerland. But it was actually working relatively well. And now we put in a new fund format in a very regulated Luxembourg fund structure. The key point is we sell this not to the investors and telling them, hey, you can come in this month and next quarter you get out. You still have a longer investment horizon, you should have, than for your normal public markets or whatever savings accounts, right? The key thing is the usual private equity liquid structure, they run 12, 15, whatever years, and that fund you have a 3, 4, 5 year hold period, and that's usually the cycles we've seen. So we tell every investor, according to our forecast, there will be at least, based on our knowledge pattern, but also market cash flow pattern, there will be once every 10 years a liquidity crisis, and we will have to gate the fund. And the gate means, in our case, investors can get a maximum of 20% of the fund's holdings back per year. So if it's getting, actually 5% per quarter. If it's getting beyond that, we have to gate the fund because it doesn't generate that liquidity. And so we tell that every investor, and for that reason, the hold period should be longer than the average, whatever, mutual fund or whatever. But the key thing is it's much, much shorter than if you go in these illiquid fund structures.
Excellent. Being conscious of time, we have one question.
Thank you. My question is concerning the subsegments and evergreen structures. Would you say that one subsegment or two are more suited for evergreen structure? I mean, private credit, real estate, private equity, infrastructures, or would you say it's the same game independently of the subsegment?
If I may take that, but then also don't want to take all the speaking time. So we have semi-liquid products across all this, what I mentioned before, private equity, private infrastructure, private real estate, private debt. Real estate is the easiest one because they often have underlying open-ended funds, so you can redeem. They also have the liquidity issues here and there, right? But in principle, it's more liquid. Private equity, private debt, I would say, is the second more liquid because of the holding terms and so on. So then private equity is the third. Infrastructure is the worst in that sense, right? So the liquidity management of this fund structure has to include that, right? So, and then in private equity, for example, we decided to go for secondaries because that average maturity of secondaries is still the best one you can have in the private equity world, right? So we think we have the most liquid private equity semi-liquid structure that is around there, but knowing it's still less liquid than, for example, a semi-liquid real estate fund, right? So you have to definitely tackle the specifics in a fund structure, how the investors can get in and get out. And very important, also required by the regulator, that you tell the investors what this means for them. And this is why I go back to a point I said before, investors need to know what they are doing. And so semi-liquid is not suited for every investor because they need to somehow understand that and relate to that.
Thank you. I think we are at the end. I could continue, but many thanks, Markus, Thomas, Natalka, Primal, for your contribution. I think it was an excellent speaking panel. Thank you very much. Thank you very much for joining us.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.